Good evening. Welcome to tonight's presentation on the economy and also on the election. My name is Brian Beatty. If I haven't met you, welcome. I'm one of the partners at EBW, and I'm going to introduce our two speakers. Brian Levitt is from Invesco, and Brian Levitt is a global market strategist at Invesco. He's actually spoken at our client events a couple of times before. So if he looks familiar to any of you, he has actually presented before. He's the author of Invesco's compelling wealth management conversations program, which helps with investors managing their emotions and their stock and sticking to their investment profiles when the stock market gets crazy. Mr. Levitt is also a co-host of Invesco's Greater Possibilities, a podcast. He's the author of Invesco's Above the Noise monthly newsletter that goes out to individuals in the business to help them with their practice. He is also frequently quoted in the financial services media in Barron's, Financial Times, and is frequently seen on television on CNBC, Bloomberg Television, and Yahoo Finance. And he will be our first speaker, and he will be presenting the elections. You may care who wins the elections, but the markets don't really care, right? It's pretty well titled presentation. But without further ado, Brian Levitt.
Thank you. Everyone, thanks so much for joining. I am going to be presenting about the elections. So I'm going to do something that my mother told me never to do, which is talk about politics and mixed company. And if everybody wants to stick around for dessert, I'll be talking about religion. So please join me. So this presentation, I titled it, People Care About Elections, Markets Don't, because every 4 years I hear a lot of concerns about what the upcoming election is going to mean for markets, and yet there's nothing in our historical data to suggest that this is anything that we should be overly concerned about. And so I figured I would spend some time with all of you trying to help you come to that conclusion, or at least come along to where I am on that conclusion. And I'm also going to take a couple of detours and address maybe a few other things that may be on your minds, or a few other things that may concern you over the course of this. And then I'm happy to open up to any questions. So let's dive into it. The first thing I hear from people before we really get into the data, the first thing I hear from people is that these are the most uncertain times. We've never dealt with problems like this before. This is all so new. We've never seen such vitriol and so many challenges all at once. And so I wanted to get a sense of what it is, what are the problems that people are most worried about. And so I went onto the Gallup polling site. Question, what do you think is the most important problem facing the country today? And you get economic answers, you get non-economic answers. And if you look on the left there, the economic answers are right there. The first one is the economy in general, which I think is somewhat ironic given the current strength of this economy and the historically low unemployment rate. High cost of living, I think we all get. Federal budget deficit, debt, I'm going to talk about. I know that that worries people. And yet, if you look at my left column of quotes and you look at some of the things that our founding fathers were worried about, Thomas Jefferson called the U.S. central bank a deadly hostility. James Madison said the public debt is a curse. Ben Franklin said inflation's a tax upon all of us. So when you think about problems from the perspective of what our founding fathers were worried about, it's hard to suggest that these are new problems. Now, on the non-economic side, the three that have risen to the top, immigration has rocketed to the top in recent months, poor leadership, unifying the country. And if you look at the charts on the right, Alexander Hamilton, he himself, an immigrant, said immigration is dividing the community. John Adams said democracy never lasts long, it soon murders itself. And none other than George Washington said that distemper in our nation is incurable. Okay, so those are quotes that you probably wouldn't be shocked to see in today's newspaper. And yet these are what our founding fathers were talking about 250 years ago. So no, the problems aren't new. Then we jump into the data. Every 4 years when I hear people's concerns, I get the sense that they believe that a candidate, a political party will come into power and meaningfully derail the economy or be terrible for the stock market. And yet, this chart goes back to 1957 and suggests that neither is the case. It's a scatter plot chart. The way to read it is on the x-axis across the bottom. It's the economic growth that we had as a country during each of these administrations. On the y-axis up and down, it's the stock market performance of the S&P 500 during each of these administrations. And so we plotted everyone. And I want to start with the x-axis, the economic activity under each administration. Notice that that scale on the x-axis at the bottom starts at 1.5%. It doesn't start at 0. It's not negative. It starts at 1.5%. And of course, what that means is every president going back to Eisenhower, which is as far as this chart goes, has experienced economic growth. Nobody came in and derailed the economy in a meaningful way. Now, if you look at the y-axis, which I think more people have concerned themselves about, the stock market performance. Notice I drew a solid black line at 0 to show you how many of the presidents experienced positive market performance compared to those that didn't. Not only did I draw a line at 0, I drew a line at 10%. The reason I drew a line at 10% is because when you get 10% per year, you're doubling your money faster than 8 years. Okay? Most of them are above the 8% line. I'm sorry, the 10% line. The only two observations of negative returns over the course of an administration in the last 7 decades is George W. Bush and Richard Nixon. And they both had terrible luck. They both left office in very severe recessions. Besides that, everybody else has experienced positive returns. The path of travel, the range of returns is fairly similar across administrations. So now this goes back to the Kennedy administration. If you look at all their pictures and you go up, you'll see a series of dots. Every one of those dots is a 1-year return at any day in their administration. Make sense? A rolling daily 1-year return. And what you find is the path of travel, the range of returns across most administrations is quite similar. You find that they almost all get to experience a 35 to 40% increase at some point, and they almost all have to deal with a 15 to 20% decline at some point. And I'll ask you to look on the far right of this chart where you'll see Donald Trump and Joe Biden, and notice how similar their range of returns are. Okay, almost exactly the same. You'll notice that they both got to experience close to 40% gains over a 1-year period, and they both had to experience 20% declines. Now, those 20% declines, coincidentally, came in their second year. Trump 2018, Biden 2022. But what was not coincidental was that in those years, the Federal Reserve was raising interest rates. Okay, you raise interest rates, equity valuations tend to come down. It's not as if they became bad for markets. There were other things at play, right? Federal Reserve was raising interest rates. So yes, the range of returns across most administrations is similar. When you do what I do for a living, people will come up to you in years like this and say, or coming into this year, should I sit the year out? Should I not invest? And, should I be worried about volatility in the few weeks or months ahead of the election? Well, so far, how has that worked? Certainly not a year we would have wanted to sit out, right? Not really in October we would have wanted to sit out. Now, the things I'll hear are, well, maybe I'll just wait to see if my preferred candidate wins, if my preferred party wins. What I wanted to do was go back as far as I could and find out whether this would have been a good investment strategy. Okay, so what this chart is showing you, the gray line is if you took $10,000 and put it into the Dow Jones Industrial Average in 1896, when Grover Cleveland was leaving and William McKinley was becoming the president. I had to look that up. Why Dow Jones? That's the index that goes back that far. Okay, $10,000 in the Dow, 130 years later, that gray line is worth over 10 million. And that's only price return. That index doesn't include dividends. We can't go back that far with dividends. The two blue lines at the bottom are if you only invested when the Republicans were in office or you only invested when the Democrats were in office. You climb to a few $100,000. You've all probably seen those charts. What happens if you miss the best 5 days in the market? What happens if you miss the best 10 days in the market? What if you miss 4 years? What if you miss 8 years? Right? What if you are a Democrat and you're not invested for the Reagan 80s? What if you're a Republican and you're not invested for the Clinton 90s? Well, that's what the chart ends up looking like. Now, nobody's actually doing this, I hope. But they're asking me the question, right? So this is my illustration to address that. Investors would have been better off staying fully invested. This election is going to be the most important one of our lifetime, right? We ever heard that before? We hear it every 4 years. I will let you all decide that from a political perspective, humanitarian, whatever. That's not my job. I'm not here to offer a political opinion. I adhere to the advice of Michael Jordan. Michael Jordan was once asked how come he doesn't take up liberal causes. He said, because Republicans buy sneakers too. So that's how I think of these things, right? This is not about my political views. But what you find is every 4 years, we're scared into believing if the other person wins, it's going to be terrible for the markets. Does anybody ever go back and actually look? I do. Okay, so in 2016, Hillary Clinton said, and quote, if Donald Trump wins, he will treat the economy like one of his casinos. We will all go bankrupt. In 2020, Donald Trump said, if Joe Biden wins, your 401k will go to zero, the market will go to zero. Well, let's take a look how we did. This chart for both of these presidents starts on the day they were elected. And it's a cumulative return of the market from the day they were elected through the number of trading days that they're in office. We start with the light blue line. That's Joe Biden. Okay? Biden was elected on November 3rd, 2020. And he's now been president for, I think, 991 trading days. And the market's up 71%. The dark blue line is Donald Trump. He was elected on November 8th, 2016. In his first 991 trading days, the market's up 65%. It's almost the exact same thing. Now, I hate that one's above the other right now because it makes it seem like I'm trying to make a statement I am not. I really enjoyed presenting this at 957 days when they were right on top of each other. But so be it. This is the point. What are we talking about? 71% versus 66%? This is what we're also worried about. Not only that, the patterns are remarkably similar. Strong in year one. Fed raises rates, you come down. Fed stops raising rates, you rip higher. Now, Trump had to deal with COVID, admittedly. Gets back up on that trend. And again, we end up in just about the exact same spot. If you're upset because Biden's 5% higher than Trump, just look that Trump was doing better than Biden before COVID. Fair? We're all still friends? Good? Okay. At this point in the presentation, people will usually say to me, that all sounds good, but you're talking about the broad market. Surely there has to be sectors, industries, different parts of the market, nuances that you see, you prefer based on who wins. So tell us what the sector or industry call should be if Trump wins or if Kamala Harris wins. And I've been doing market strategy now for 25 years. And when I was taught market strategy, I was taught you really need to answer three questions. Where are we in the business cycle? What's the next most likely direction of the economy? What's the Fed going to do? No one ever added who's going to win the presidential election. Now, the only way you would want to add who's going to win the presidential election is if it meaningfully changes the answer to those three questions. And it typically doesn't. So when I think about sectors and industries, I'm focused on the direction of the economy, what the Fed's going to do. I'm not focused on which sectors or industries it seems to me that the candidates would prefer. I'll give you an example. If we had met in November 2016, day after Trump won, and I said to you, what's going to outperform, traditional energy or clean energy stocks? What would everyone have said? Traditional. Well, how did that work? Look at the chart on the left. That's the performance cumulative of traditional energy and clean energy under Trump. Clean energy up about 150%, traditional energy down 50%. How can that be? What was the direction of the economy? Pretty slow, and then we went in a pandemic. Not good for traditional energy. What did the Fed do? They lowered rates to zero. Well, which businesses need to borrow money to sustain themselves? Clean energy, right? You lower rates to zero. Clean energy looks a lot more formidable. Now, look at the chart on the right. If we were to have met in November 2020, and I said, Joe Biden just won the election, is that going to be better for traditional energy or clean energy? We all would have said clean energy. Why? Green New Deal, which ultimately became the strangely named Inflation Reduction Act, right? Well, what won? Traditional energy up 225% or so. Clean energy down about 50%. What gives? What was the direction of the economy? Big nominal growth environment. Now, nominal means we include inflation, right? Big nominal growth environment. What does well in a big nominal growth environment? Energy. What did the Fed have to do? Raise rates to 5.5. Which companies borrow? Clean energy, right? So even in those two most important elections of our lifetimes, it's still held direction of the economy, Fed, matters far more than the policy platforms of the administrations. The reality is, we're not structured as a system to make radical changes that meaningfully change the construct or the direction of the economy. Now, every 4 years, we're told that we can, and in the next few weeks, you're going to hear things like socialism and fascism and communism and uber capitalism and pickenism of your choice. The reality is that's not how the system operates. Nobody's going to come in and radically re-engineer the US economy. As my 13-year-old is learning in her civics class right now, we have a system where we have 3 separate but equal branches of government and a system of checks and balances that make it very difficult for any one person or any one party to radically re-engineer the economy. To prove it to you, the chart on the left is the construct of the US economy. Now, if any of you took economics classes, you may have had a professor stand up at the board the first day and say US GDP is equal to C plus I plus G plus net exports plus NX. I know you all remember that very well. Okay, so what does that mean? The US economic output is equal to the consumption, that's us, what we consume, business investment, government spending. And the US net exports is a detractor. So that's the picture of it back to 1956 on the left. The top blue, the dark blue, is us, the consumer. The middle light blue is business investment, and the bottom is government spending. And you add up the consumption plus the business investment, 80-something% of the economy. Okay, it's a private sector driven economy. But what's also interesting is how remarkably stable it is. You don't see this thing whipsawing all over the place. Nobody radically re-engineers the US economy. Now, there may be moments where you see the light blue, business investment, coming down a bit, and that bottom blue going up, government spending. Those little blips, we call those recessions. Okay? Other than that, remarkably stable. The chart on the right is a study by Pew Research where they had said, what are the percent of substantive bills signed by congressional term? I don't really know how they define it. I'm not sure how interesting it is. But what I found interesting was when you look at when there's single party rule, which I highlight, you don't see that line go up a lot. In essence, the way things happen is investors look at a policy platform and assume it's all going to happen. Politicians get into office, first they have to have the Congress, which isn't always a foregone conclusion, but even if they do, they maybe get a couple of major things done, maybe a couple of accomplishments. And then we kick them out of office in the midterms anyway. It's the one thing Americans can agree on. We don't want anyone to have power for too long. Okay, back to that left chart, that government spending. I know people worry about the amount the government spends, so I am just going to take a brief detour talking about the election just to cover government debt and deficits for a second, because I get the sense people worry about this. Anyone want to nod? Do they worry about the government debt? Anyone up at night thinking about it? Yeah. That's not what I think about at night when I can't sleep. Anyway, usually like some regret from high school or something. But anyway, okay. So the way to read this chart, the black line is your government outlays as a percentage of GDP. So all the things that we spend money on. The light blue is what we bring in tax receipts as a percentage of GDP. The gap between the two is either a deficit or a surplus, and almost every year shown here, it's a deficit. Not every, but almost every. And then I color-coded it based on which party occupied the White House. Good? I'm going to make 4 main points here real quick. The first one is neither party can really claim fiscal responsibility. The second one is, if you look at the big deficits that we've run, a lot of them are in the last 15 years. And that's really because our government had to respond to 2 major crises. Borrow money in an attempt to counteract what could have been really terrible economic environments. And if I were to have told you 15 years ago we were going to have a global financial crisis and a pandemic, you probably wouldn't have thought 4% unemployment, all-time high in the stock market. How is that possible? We were able to keep businesses and households going through 2 terrible environments. So point 2 is, before we get too upset, let's at least be happy that we live in a country that can do that. Point 3 is not shown on the chart, but when you run deficits like this, you add to the national debt. And today the national debt is $35 trillion. And someone told me if you stock dollar bills from here to the planet Uranus, you will not get to 35 trillion. So that's a large number. And it worries a lot of people, but you have to put it into some context. 35 trillion is a large number, perhaps until you consider that the total household net worth in this country is $150 trillion. And so think of it from the perspective of your own household. If your personal wealth was 6 or 7 times your debt, you probably wouldn't be all that worried about it. Right? And that's why I think investors aren't worried about the debt of the US government. This is a very wealthy country. Point 4, people think that, yeah, it's all fine until interest rates go up. Interest rates track the nominal growth of this country. Interest rates aren't just going to shoot up for no reason. They track the nominal growth of this country. We have a very captive audience for US debt. Who owns US debt? Federal government entities, some of whom are set up not that far from here. They're going to own government debt. US banks have to, regulated. US insurance companies have to, regulated. US mutual funds have it in their prospectuses that they have to own it. Pensions, endowments have it in their policy statements. My dad loves it, 4%, so happy. So US savers, Foreign investors, the Japanese, the Germans, the Brits, they love our yields. So my point is just to say that this is not the problem that people suspect it to be. And I don't lose any sleep over this. I lose sleep over high school, not over this. Monetary policy matters more. Okay, I'm from New Jersey, but when I take my family to Washington, D.C., I say, all right, we're not going to go to the White House yet. We're not going to go to the Capitol. We're going to the Federal Reserve Building because I want to show you where the real power is. All right, none of that's true, but I would, maybe. So this is a chart of financial conditions. What does that mean? It basically means if the line's going down, it's easier to borrow. If the line's going up, it's harder to borrow and things are getting tighter. Who usually controls that? The Federal Reserve. Okay, they decide whether policy is going to be tight or easy. And if you look at the great performance that a lot of our presidents take credit for, Clinton in the 90s, W in the middle part of the 2000s, Obama after the global financial crisis, it was periods where financial conditions were easing. Now, if I was president, I would take credit for it too, but I would also write a little thank you note to the Federal Reserve. Now, if you look more recently, look where the line's almost all the way down at 97, all the way down there at the bottom. That was the easy environment after COVID, which benefited both Trump and Biden. 2022, that line shoots up, right? Because we've got to raise interest rates to break inflation. Bad time for markets, bless you. More recently, that line's been coming down. How have the markets been as that line's coming down? I'll add Biden to this after November 5th. This part, but that very good performance. Where's that line going over the next year? What's the Fed telling us? Easing? Doesn't matter if it's Donald Trump or Kamala Harris. That line's probably going down, right? So it should be a good backdrop for either. The market doesn't care if we don't like who's president. These are the approval ratings at the top of each of the presidents going back to Kennedy. The first thing I noticed when I looked at this, I said, gee, we really used to like the president back in the past. You know, you'd have these periods where more than 50% of the country liked the president. We haven't had that really since the second term of W. Bush. We've been mired in this environment. It's probably right around the time that the cable news networks made us think that we all don't like each other, even though I travel the country every week and we all like each other, believe me. So right around the time the cable news networks told us we don't like each other, we've been mired between 35 and 50. W. Bush, almost the entire second term. Obama, 75% of the time was between 35 and 50. Trump, 100% of the time was between 35 and 50. Biden, 85% of the time has been between 35 and 50. And yet, the market did very well under Biden, Trump, and Obama. In fact, if you go down to the bottom, I'm looking at the S&P 500 returns in the different cohorts. The market actually does best when the president's approval rating is between 35 and 50. So the reason I tell you this is because it's going to be a very close election. You've all seen the polls. It's very tight. Every swing state looks tight. Half the country's not going to be happy. Maybe a little bit more than half the country's not going to be happy. And so what I want you to remember, if you're unhappy, if your friends are unhappy, if your family's unhappy, you can say, well, at least the market prefers it when we're unhappy. My last two charts, I think starting points matter a lot for presidents. And it explains how two men that I think many people would consider as modern standard bearers for their parties, who don't have a lot in common politically, but both had very similar returns in their 8 years in office. Now, how could that be if politics matters so much for markets? The reality is they both had great starting points. And quite frankly, I wrote a blog in 2020 where I said Biden has a very similar starting point. So if you're a Trump fan and you're disappointed about this, remember he's got one of these great starting points that not every president gets. Now, what are the starting points? If you look at on the left, think about when Reagan became president, think about when Obama became president, and not pictured, think about when Biden became president. The term begin in a recession? Yeah, Biden close, but Reagan and Obama definitely. Were stocks historically cheap? Yeah. Was the Fed trying to solve a problem in the economy? Yeah. In Reagan's instance, they had killed inflation, the 70s inflation. In Obama's instance, they were trying to help the global economy heal from the financial crisis. Were there good demographics? Yeah. Reagan had the baby boomers, Obama still had the baby boomers and the millennials and the emerging market consumer. Okay? That's what matters. Take credit for, my policies did this, okay, but sometimes you're just lucky by your starting point. Now, the next starting point, whether it's Trump or Kamala Harris, is not going to be as good, but it's going to be fine. Term begin in a recession? I don't think so. Are stocks cheap? No. But if you look at the other 490 names in the S&P 500, not that expensive. Top 10, maybe. The other 490 names, not that expensive. Is the Fed helping? We think so, right? Do we have good demographics in this country? Pretty good. A lot of people don't think so, but this country is mostly 30-year-olds and 60-year-olds. I'm 48. There's none of me. I tell people it explains how I got into college. There was nobody else applying that year, um, but anyway, starting point should be fine for either. And then finally, I've been doing the political presentation since '08, and just got to thinking when I was pulling this one together. Everybody's been so focused on politics or the geopolitical situations in different parts of the world. Just think about all the innovations and advancements that have happened in the short period of time that I've been doing these presentations. You know, and the ingenuity, the innovations, the advancements just keep on going. In 16 years, we've gotten cloud computing and 3D printing, and I was going to say social media, but I don't think that's helpful. Electric cars, virtual meeting software, gene editing, smart homes, artificial intelligence, and on and on and on. And quite frankly, I can't wait to see what the next 4, 8, 12, 16 years bring. I think it's going to be absolutely stunning. And that's very much irrespective of who wins the election in a couple of weeks from now. So thank you all. I will show you my disclosure so I keep my job and ask to see if there's any questions that anybody would want me to address. It could be on this or global economy or markets. Please.
Yes, I have two questions related to the possibility of a Trump presidency. The first, you mentioned the Federal Reserve. My question there is, the Federal Reserve has historically operated independently. What is the risk to the Federal Reserve, in your opinion, if Trump is elected? And my second question has to do with all of the talk about tariffs,
Mhm.
which I believe the president can exercise without
Yeah.
without Congress.
Okay.
So those are my questions.
Yep,
Thank
great questions. Absolutely great questions. So the first one, the independence of the Fed, I think is critical. And Trump has mentioned a few times, not necessarily about wanting to break the independence of the Fed, but having his opinion respected by the Fed. And so you don't want to conduct monetary policy based on what a president would want, because the president's interest may not always be aligned with the need to have price stability. Right. So you saw that a bit in the 70s, where Richard Nixon had asked Arthur Burns to keep rates low until Nixon got reelected, and inflation can start to build in those environments. So the independence of the Fed is critical. The independence of the Fed is one of the things that keeps interest rates low in this country. Keeps interest rates low because people believe in the credibility of the U.S. Federal Reserve. Now, it's not so easy to just say, I'm going to take over the Fed. You would need an act of Congress for that to happen. And so I wouldn't worry about it from that perspective. Now, you could say, is the president going to potentially jawbone the Fed chair? Well, they all jawbone the Fed chair. So far, the Federal Reserve, to me, in my opinion, has been acting very independently. And so, and remember, Trump was the one who put Jerome Powell there to begin with at the Fed. So I would say my answer to that is the independence of the Fed is critical. You need an act of Congress to change it. Presidents may try their hardest, but the bond market right now still very much believes in the independence of the Fed. If we start to see inflation expectations in this country move up meaningfully, that would be a different story. And I think it is a risk, but I don't like to hear him mention it, right? Because I think that's like that's the third rail, right? Let's leave the independence of the Fed because Americans need to know that the central bank is operating in a way that your money has stability of value. Now, with regards to tariffs, one of the first courses I took in economics was all about how economies evolve, not only the country you live in, but how economies evolve around the world. Okay, so the natural movement is you go from agrarian to industrial to service to knowledge-based economies. And while you're moving up that value stack, you're leaving behind the other things that other countries can do, right? And so your standards of living go up because pay tends to be higher in service and knowledge, and other countries with lower wages are producing your goods. And that's where the United States has been for the last bunch of decades. Standards of living have improved. To the extent that you want to protect industry or protect manufacturing in your country, you're going to have a less optimal economic outcome, right? It's just the way it is. It doesn't mean it has to be a disaster. It just means you have a less optimal outcome. Now, you may do that. There might be critical reasons why you do it. National security, restore health to certain cities in the country. Right? There's reasons why you would do it, but you would likely have a less optimal outcome. What's critical to markets and what's critical to businesses is clarity around it. If you think about 2018, there were a lot of investors who were concerned about the market when we did not understand the terms of the trade war that we were battling with China. In fact, in 2018, business investment dried up for a bit because the businesses didn't understand the rules of the game. As soon as we got clarity on it, 2019, not many people were thinking about the tariff rates. Right? In 2019, we got clarity, businesses were back investing again, and the economy was moving. So to me, what's going to be critical on this is understanding the rules, clarity around how we're going to do it, if we're going to do it, and also know currencies will adjust to offset it. Right? You put a tariff on this good, the currency will move to make the good more attractive to you. So I don't think it's going to be a huge challenge for the economy.
I appreciate you talking about the petroleum industry sector. I work for American Petroleum Institute, so that's my sector. Could you comment on how you feel the influence of geopolitics?
Yeah.
Not because clearly, we've already been talking about it for a while. That until such time as the wars in the Middle East start affecting petroleum production, not an issue. There's actually still a surplus. Gas prices are still down.
Yeah.
But talk about it from the broader perspective.
Yeah, it's an excellent question. You think about what's going on in the world, I think a lot of people wouldn't have thought that the markets would be at an all-time high or near an all-time high. So what gives? If we go back to my questions around direction of the economy, what's the Fed going to do? I also look at global conflict and war through that lens as well. Will this event change the direction of the U.S. economy or what the Fed's going to do? And Russia, Ukraine, and Israel and the Iranian proxies certainly had the potential because of them being oil-producing countries. The reality is right now the world is awash in oil, to your point. I mean, this is not the 1970s. The U.S. right now is producing something like 13.5 million barrels of oil per day. That's more than any country has ever produced at any time in the history of the world. Right? USA. So Saudi Arabia is like 9.5 million barrels of oil right now. And Saudi Arabia could increase production if they wanted to. And so the world looks at Russia and and Iran right now as, yeah, troublesome hotspots in the world, but the market is very sanguine about it because of the supply of oil, to your point, that exists in the world. So those things will likely continue to play out in the background of the market unless it's wider and has more meaningful implications on US or Chinese growth or inflation. And for the past couple of years, that has not been the case.
I'm sorry to bring it back to tariffs,
Yeah.
but I'm confused. I didn't quite follow your response. So, as I understand it, one of the political proposals on the table is to raise tariffs by as much as equal to 50% on everything coming into this country,
Mhm.
which, by non-economic educated perspective, seems really high.
Yeah.
And I also understand that part of the logic behind that being proposed is that then we Americans will suddenly start building factories and producing all this stuff ourselves. I'm thinking it takes time to get land, build factories, source the equipment for the factories. Doesn't make sense. That's my question.
You're absolutely right. You know, it'll be more costly to produce here and it will take time to increase productive capability. Does it make sense? Depends on where you sit. Okay. If you have national security concerns, if you are trying to defend industry in certain parts of the country or bring manufacturing back, then yeah, it could make sense. But my point in saying it, you get a less optimal outcome is because it's going to cost more. Now, Trump's point is to say you bring that into the country, you get more growth than the cost. But to your point, that would take time to learn, right? So therein lies the debate, and I'll let the voters decide on that. So my point is to say that businesses will be okay if they understand the rules and currencies adjust. So if all of a sudden a good's going to cost you 50% more coming in from Mexico, the peso will adjust to reflect that. And the consumer may not feel it as much because your dollar will buy more. Dollar's going to get pretty strong if we put tariffs on goods like that.
Is there any tax policy of the candidates that you think would make a difference? You know, like raising taxes on corporations
Mhm.
or a wealth tax? And secondly, do you think wealth inequality is a problem?
So the first one, yeah, the tax cuts that Trump put in place in 2017 will expire in 25. Now, we've been down this road before. Everyone remember the fiscal cliff in 2010? We were supposed to be terrified that the Obama administration was going to allow all the Bush era tax cuts to disappear. Nobody even remembers the fiscal cliff anymore, huh? It was a big deal. We used to have to write papers on it. And what ended up happening was you were in a weaker environment, and the Obama administration extended the tax cuts for 2 years and then signed the American Taxpayer Relief Act, which actually extended 82% of the tax cuts. So the concern I think people have right now, the knee-jerk reaction is if Kamala Harris were to win, then those tax cuts go away. Now, we would revert back to where we were in the Obama years, right? But I don't think any of us want to see, maybe do, tax rates go up. So I think my first answer to that is we can't always say with certainty that that's going to be what happens. If I was talking to you 4 years ago, that most would have asked if Biden was being serious about taking the capital gains rate to 43.4%. Remember that one? And it didn't end up happening, even though he had single party rule for 2 years. So these politicians talk a game on the campaign trail, but you've got to be, once you become president, you've got to be really laser focused on what you want to accomplish. And it remains to be seen. I don't think if Kamala Harris is to win, and again, it is tight, I don't think she would have the Senate. So it would be challenging. Now, interestingly enough, we've raised the corporate tax rate 5 times in the last 75 years, and the market was up in all 5 of those years. I don't know why, but it was. The tax on the unrealized gains, that's not going to happen. That's just something that sounds nice to potential voters. That's not going to happen. I don't even know if that's legal. I don't know how you logistically do it, but that's not going to happen. Now, is income inequality a problem? Yeah, sizable amount of wealth accruing to a small subset. For you, can I get in the will? Um, it, so is it is it an issue? I don't want to look at it from the perspective of we don't want entrepreneurs to be incentivized to do great things, and these small business entrepreneurs are the ones that drive hiring in this country. So I'm very much a capitalist, and I don't want to say that um, we shouldn't reward people for the risks that they take. I think the challenge that we have right now is that when wages are going up at the top end, or uh, gains are accruing to the chief executives, we let that go. As soon as wages start accruing to the workers, we tighten rates pretty significantly, which is what we had to do here, where we finally saw workers. Remember the Great Resignation? You couldn't find enough workers, and we got some wage growth, but then we clamped down on it. So no, I don't want to see small business entrepreneurs disincentivized, but I'd like to see some policies that help bring more. I'm not running for office. Well, I'm not running for office. I'm just telling you the markets are going to be fine.
Difficult to formulate this as a question. So probably I would like to elicit your observations between the two candidates. I would have loved to, great data. I would love to see some associated slides on immigration.
Mhm.
That's a kind of a latent and hidden object. To start off at the outset, I would like to mention that there are certain people who have followed the right immigration rules, typically 13 to 14 years to get adjusted, underlying the meritocracy principles of USCIS, et cetera, et cetera, et cetera. But then there are bulk of people who have circumvented that process. So again, not a question, but a comment from, I would like to elicit from you is that between the two candidates, how do you see going forward? Because this is crucial for our country's economic engine, how we build a workforce engine to go 5, 10, 15, 20 years um, towards and to bring in immigration and to how do these two candidates you see what I'm not going to go in policies, but what do you think is going to be
If you look at what economic activity is, economic growth is essentially labor force growth plus productivity. So how many people are you bringing into the labor force, and how effective are they at producing things? And as the population ages, the labor force in this country ages somewhat, not terribly, we're not Japan, but as the population ages, you would expect economic activity to be lighter unless you have pretty significant productivity gains. Okay. And so as our population ages, you can replace with immigration. And of course, immigration has been a big driver of growth in this country because we've increased the labor force over years and we've brought in productive people. If you scale that back, you would have less labor force growth. You'd have to replace that with improvements in productivity, right? So it means that you may end up, if you don't have the productivity advancements, you may end up in a slower growth environment than you otherwise could have been. But slow growth environments don't have to be bad for equities. we've had slow growth environments that have been great for equities because interest rates remain relatively benign, remain relatively low. So labor force plus productivity. Who are you bringing in plus how productive are they?
Going back to taxes have consequences, and understanding that you do need an act of Congress to raise or lower taxes. I mean, one candidate is talking about raising corporate taxes and raising capital gains. The other candidate is talking about lowering taxes and lowering capital gains. Looking at the opportunities, not whether it's good or bad policy, what type of investments improve or go down in a time of capital gains going up or down, or corporate taxes going up and down. So I'm focusing on the opportunities, not the candidates.
Yeah, say smaller capitalization businesses tend to pay higher effective rates, tend to benefit from lower corporate tax rates, tend to have less ability field. And if you do get a pop in growth from lower rates, which would be the goal, then smaller, mid-sized businesses would tend to do better than the big mega cap companies who historically have been able to pay lower effective rates. I mean, could potentially see, investors where investors are sitting with significant capital gains right now, you could potentially see them try to front run it, right? So I don't know if the data really plays that out, if the data really shows that people sell ahead of it, but a lot of the big capital gains are accrued to the mega cap tech businesses right now. Perhaps you could see some people try and get ahead of that. I'm not sure that that would be the right investment policy, but perhaps you could see some of that. There's less of that in value-oriented stocks, which haven't performed as well, or small cap stocks that haven't performed as well. All right. Thank you all very much. Appreciate it.